Hey, my name's Matthew, and here's a short introduction to finance. So, first, our learning outcomes is that we want to understand the basic functions of money. We want to learn about the basic concepts of financial systems. We want to learn the terms to explain money and finance, and we want to use that knowledge to make our own personal financial decisions. So, short introduction, why should we learn about money and finance? Money and financial markets allow for a more efficient economic activity, such as commerce and trade, investments and growth opportunities. They aid in the creation of businesses and provide us with the means to acquire resources we need to live and thrive. Here are some early examples of money and finance. So first, early Sumerians kept financial transactions that included ownership and rental of land, agricultural labor, and loans. Cowrie shells were once used as a form of money in China, and all the way back in ancient Rome, temples were once the financial hub of major cities. So, what is the barter system? The barter system is the oldest form of commerce. It's basically the exchange of goods and services between two or more parties without the use of money. An exchange takes place when all parties agree upon an estimated value of the goods or services. And the bartering system is actually still used in some parts of the world. So, more about money. What is money? Money is anything that can be used as a medium of exchange and accepted as payment for goods and services. It's used to buy the things that we need to live and thrive. And before the paper and coin money that we have today, past civilizations used any type of objects, basically, as their money, including tea, gold, cattle. These are all examples of commodity money because the items have value in themselves as well as value at their use as money. So how is money used? Money can be used in three ways. Medium of exchange, where money is accepted as a payment for goods and services. Store of value, where money can be used for being saved for later use. And union of account, where money gives us a standardized metric that allows for us to measure the value of things. So what is the gold standard? Money used to be backed by gold, meaning each dollar was redeemable for a specific amount of gold. The U.S. Reserve couldn't issue more money than what it was had in the gold reserves. But in the 1970s, the US eliminated the gold standard because the demand for money was higher than the supply for gold. Our current form of currency is considered flat money, meaning its value is established by the backing of the government. The health of the economy backs the dollar's values. With economic stalls, the dollar can decrease in value through inflation and international exchange rates. So, here's our examples and definitions of money and currency. Money is a system of perceived value, allowing for the exchange of goods and services. And some examples are the US dollar, the euro, Japanese yen, silver and gold coins, and cryptocurrencies. For currencies, it's a physical form of money issued by a government and used within a particular jurisdiction. Currency can lose value over time. And some examples of these are, well, the same things, the US dollar, euro, Japanese yen, but they do not include silver and gold coins or cryptocurrencies. They are instead other physical forms of money issued by a government. So now, focusing on finance. What is finance? Finance is the management, creation, and study of money and investments. It allows us to borrow and lend money, invest, raise capital for a business, and trade on the market. Because of this system, we can fund our projects and activities today by repaying in the future. With finance, we can buy homes, cars, pay for vacation, and we can also build our own businesses. And basically, the financial system is a network of institutions, markets, and contracts that brings lenders and borrowers together. This system only works when lenders and borrowers work together. And lenders are basically anyone, from corporations to individuals, and as the name suggests, they lend money to people. Most charge interest to make it worth their own while. Borrowers are people who, well, borrow money, these are called loans, from the lenders with the intention of paying it back with the applied interest. So the lenders can make profit and the borrowers can use the money for whatever purpose. Money is borrowed to invest in capital for businesses, purchase property, and to pay for other goods and services. Lenders and borrowers usually come together through banks, bond markets, or stock markets. So, some types of finance include public finance, which includes tax systems, government spending and policy, budget and debt. The federal government oversees allocation of resources, distribution of income, and stabilization of the economy. Funding for programs is often provided by states. The government also borrows from banks and other governments and earns dividends from its businesses. Another form of finance is corporate finance, which is the management of assets, liabilities, budgets, and revenues. Businesses acquire financing through investments, loans, and lines of credit. And lastly, you have your personal finance, which is all the financial decisions and activities made by an individual or a household. This includes spending, budgeting, saving, investing, and loans. Financial planning considers the individual's current earnings, living requirements, goals, and any debts. And here's some key terms. An asset is something of value, such as cash or property. Cash flow is the movement of money in and out of a household or business. Principal amount is the original amount of money that is borrowed, invested, or lent. Liability is a financial obligation, such as debt. Liquidity has how easily an asset can be converted to cash. Profit is the money left over after expenses. And capital is the money used to build, run, or grow a business. Continuing on these, debt is borrowed money you owe to a person, business, or institution. Typically, the borrower will pay interest on the amount borrowed and expected to pay it back within a specific time frame. Equity involves leadership or ownership. It is often your total assets minus total liabilities. Examples include ownership in a company or the value of your home after subtracting the mortgage balance. And lastly, interest, which is the price you pay to borrow money or the return earned on an investment. There are two types of interest. Simple interest, which is basically the interest added to the principal amount one time, or compound interest, interest that is added periodically and charged on both the principal amount and the accrued interest. You can also earn interest on certain accounts, such as savings accounts through a bank. So, what is financial education? Money and finance play a large role in our everyday lives. Monetary policies influence the functionality of our economy. They also influence our individual choices on spending, saving, and investing. Education in money and finance allows us to understand financial concepts and practices so we can make informed decisions that impact our future.